There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have a good friend of mine on the line, and that's Jim Tassoni. He is founder and chief investment officer of Durand Capital Partners. He's been taking it easy on me on the Michigan situation, so I appreciate that. How you doing this morning, Jim?
I'm good, Joel. I'm good. Thanks for having me on. And yeah, for all you Michigan fans out there, as Joel knows, I am a Spartan, a Michigan State Spartan at heart, and my wife is as well. So I've been taking it easy on Joel. We've had plenty to chide him about on that front, but we are enjoying our team. And Joel, I don't know if your Michigan faithful and friends would want me revealing this, but I have seen you flash a little Spartan green over the last few years, which is a big change for you.
My daughter is a freshman there, so my wife warned me years ago. But Jim, let's go on to the markets here. And the first thing I want to talk to you about is you and I did some short-term trading together, and it was a few years back, and the game has changed a lot and constantly changes. For people that, let's say, they have some money that they feel that it's risk capital and only risk capital, and they want to venture into short-term trading, what words of advice would you have for them?
Sure. On the short-term trading front, I think you hit it right on the head. I think first and foremost, you really should only be investing on the short-term front with that risk capital or with that money that you are okay with losing or seeing go to zero. So I think the key on that front is, A, develop a very disciplined money management process in terms of how much you're willing to allocate and how much you're willing to risk in losses. And then, 2, I'll go back to having a plan and working that plan. I think you can get yourself in trouble very quickly, especially in the short-term trading world, if you don't come in every day with a systematic, detailed, and disciplined plan for how you are going to trade that day. If you try to feel the market or work through the day or see how things develop as the day goes along, so on and so forth, it's very easy as things are moving so quickly to get yourself in trouble. So having a disciplined, repeatable plan and working that plan and being systematic in your processes is vitally important. And it's important across all investing, but especially with the short-term time frame.
Fantastic answer, Jim. And now moving on to your current role, and you have over 9 years of investment experience, analyst, consultant, portfolio manager, and you've developed your own strategies, the all cap equity strategy you've been running for quite some time. Could you discuss, how much of your strategies are based on fundamental analysis? And then after you discuss that, maybe go into a little bit of how much attention you pay to technical analysis.
Sure. I would say that the strategies that we run currently at Durand Capital Partners and our flagship strategy, the U.S. All Cap Equity strategy, is a very fundamentally based strategy. So we're heavy into fundamentals. We're bottom-up stock pickers. But within that framework, I think the technology age that we're in right now has allowed or forced many people to get quantitative within their fundamental research. And it also allows us to compete with some of the big boys out there, too, because we can leverage some of the technological capabilities to put together, whether it's screening processes or filters, that help us to go through large amounts of data that otherwise would have taken 50 or 100-person analyst teams to drill through, that we're now able to do with just a few analysts on our team. So we're probably, if I had to put an allocation to it, we're about 90% fundamental, 10% technical, But that 10% is very important in the technical front because we have to be cognizant of the technicals. We have to look at technicals both in individual security selection and in the overall weighting within our model, because we do have a pretty broad-based mandate within our U.S. all-cap portfolio where we are bottom-up stock pickers. We look at individual companies, but we also have the ability to sit in cash up to 100% if necessary, and we do some technical work on that front to help us and guide us in terms of how comfortable we are and how fully allocated we truly want to be.
Okay, and then for the technical analysis, I mean, have you designed systems to give you buy and sell signals? Do you like moving day averages? Do you just like to eyeball charts? What's your preferred technical analysis method?
Sure. Our technical analysis is actually a little bit different in that we use our fundamental screens to create technical moving averages. And what I mean by this is our universe starts with all U.S. companies with a market capitalization greater than $500 million. So you've got roughly 3,000 stocks here. And on a daily basis, every morning we come in and we screen these stocks for our three proprietary metrics of growth, profitability, and financial health. And we screen down from about 3,000 to, it varies from 75 to 200 stocks on a daily basis that are screened through. And we chart this number of stocks every day within our universe. And we use that, we actually create our own moving averages through this filter that we then overlay longer term versus shorter term moving averages, with the ultimate idea being that as the stock market's running up, as valuations are getting stretched, and we're big proponents of paying attention to valuations, the number of stocks screening through our list that are showing great growth, profitability, and financial health is shrinking. And as this list shrinks, and as there's less opportunities in the market, our moving averages are going to reflect that. And so it's a bit of a contrarian indicator in that as our moving averages are getting weaker, we're going to be looking to book profits and raise cash. On the flip side, as fundamentals are improving, as valuations are improving, our list is going to expand. And as that list expands, we're going to see our moving averages moving up across the longer term overlays. And that gives us the opportunity to then say, okay, we think this is a positive time to deploy cash. So it's very systematic. We have specific levels we look for, but it's not true technical analysis in that we're looking at the same averages as everyone else. We're sort of using our own underlying fundamental analysis and creating a technical overlay within that fundamental analysis.
And Jim, could you just, I mean, you got a lot of responsibility here. You're managing a lot of money, in volatile markets. You have your strategies. Could you just walk us through like your typical, I mean, I don't want a trading day because you're not trading every day, but I mean, you got all this information, you got all these stocks, you got all these positions. How do you manage all that?
Sure. Absolutely. And again, I think it goes back to our initial conversation about having a system and having a plan and sticking to a disciplined, repeatable process day in and day out. Now, I'm one of those people who, and it probably drives my wife nuts, but I tend to be a very early riser. So I'm usually up around 5 o'clock in the morning every day. I'm in my home office. I go in, I run my screens, I have it all set up systematic, so it filters through my screens, and then I have my 100 or 150 stocks that come through. Now, within my portfolio, I own 25 to 35 stocks at any given time. So what I'm doing now is I'm looking to make sure, first of all, that all the stocks in the portfolio are currently running through my screening and that none of them have fallen out of the screen. On the next, as long as they're all still in there, then we're good to go on that front. The next part of it has to do with the ranking process of these stocks that I go through. And if any stocks currently in my portfolio have slid down out of the top 50 in my ranking process, they go on to my watch list. And then what I need to do is I need to spend some more time with these individual companies and drill into them, look at the fundamentals, figure out why are they deteriorating, are valuations becoming stretched, is there a one-time, one-off earnings surprise, so on and so forth, and try to determine, is there a fundamental deterioration in the company, should we look to be exiting, or is this a short-term blip, should we continue to hold, and or has a dislocation been created where we may actually want to look to add to the position. So that's how I start every day. I'm in the office by 5:30, and by 8:30, within 3 hours, I am done. I grab a quick bite to eat, and I'm off to the office for my day. So within 3 hours of waking up in the morning, I know exactly what trades and or investments I need to or don't need to make for the day. So I think that's a long-winded answer, again, for the people who are listening, to just say that have a process, have a plan, and get rigorous and disciplined in it. And I think you'll find that you can become very efficient in spreading your time and still being able to do your job well.
Ace in the chat room wants to know what time you go to bed.
What time do I actually go to bed, or what time do I fall asleep on the couch and have my wife yell at me?
Oh, that happens at your house too? I thought that just happened at my house. What time does she? What time do you both? What time do you fall asleep on the couch, and then what time do you finally turn it in?
I'm usually in bed. I'm usually in bed between 11:30. So I'm if I get 6.5 hours of sleep, that's prime time for me.
Okay, so you manage things on, you're looking for value, you're looking at your stocks, but you also have to, manage risk on the downside. And, how do you imagine that? I mean, I can imagine the last few days for you weren't too pretty. Did you have stops in the market? Do you try and hedge your portfolio? What do you do, for risk management on the downside?
Sure. Well, we don't use stops. I think our risk management really comes into the way we analyze companies, the types of companies we look for. We look for really stable, sustainable type of companies. And we look for companies that are selling at really attractive valuations. I mean, we calculate intrinsic values for all of our companies, and we won't buy them unless they're selling at least a 20% discount to that intrinsic valuation. So we're meticulous on that, and we think it sets us up. Every decision we make, we look at what's the potential reward versus what's the potential risk. And I think that's, again, the key for any investor, short or long term, is to have a definite plan going into any investment. So every time we invest, we know here's what we're looking for on the upside. If we're getting into a stock at $10, we've got an upside target of $17. On the downside, we know here's what we're willing to risk on this position based on a myriad of factors, fundamentals, technicals. We're willing to risk down to $9 or down to $8.50. And we have that, and it varies based on risk levels, volatility, so on and so forth for each individual position. But we always know that if there's nothing else that we're strict about, we are die-hard strict about knowing our entry and exit positions on every trade we make. And we think it's very important from a risk management standpoint to have those disciplines in place and to stick to those disciplines.
Okay, so let's just talk about the overall market here. We got up, we made all-time highs, back in September, and you
Hmm.
talked about your screening system. When we got up to those levels, and you look at your screening, and and you're down to these few amount of stocks. Does it kind of give you a feeling? I mean, have you made any correlations to when your valuations, the stocks on your radar, get that low to sell-offs in the market?
Yeah, there's a fairly decent over our decade plus managing money. There's a fairly decent correlation between those moving averages, and we've been able to avoid a fair amount of the downside over the decade by paying attention to those signals. And we are sitting in our portfolio right now between 25 and 30% cash. So
Wow.
we're a reasonably high level of cash. We raised it probably a little early in the midsummer. We've been up to that level. We've continued to just find it very difficult, as you mentioned, to find really attractive valuation stories. Now, this sell-off has us licking our chops and looking at some stocks on our shopping list that are coming into the price levels that we'd like to see. But at the same time, we're cautious on these markets. We want to be invested in good, high-quality stocks, but we also want to have a cash buffer and the ability to deploy cash quickly if we do get a reasonable pullback.
And what about the market now? Just look at the S&Ps. They're bouncing back nicely this morning, up 13 points. Ugly day in the market yesterday, climbing back up. Do you think this is just, signifying a march back up to new all-time highs? The buy the dippers are going to prevail again? Or are you playing this bounce with a little bit of caution?
Yeah, and I think that's the big tug of war that's going on right now. And you look at even the divergence in the market as a whole, with the S&P only a couple of percent off the all-time highs, but things like the Russell 2000 down 6% for the month, down 5% for the year. And a lot of those stocks are 20, 30, 40% off of their all-time highs or even down for the year. So there's breadth divergences, there's market cap divergences, and it's really a tug of war right now. And for us, we find it difficult and or almost impossible to make a call from a macro standpoint and try to guess what the market's going to do next. So we're very disciplined to our process and to finding good individual companies when they're selling at what we believe to be attractive valuations, and also following our screens and letting those guide us in terms of our overall asset allocation. And not to steal a line from Warren Buffett, but to be fearful when others are greedy and greedy when others are fearful. It has worked well for us. So that's sort of where we're gonna continue to look for opportunities.
Okay, Jim Tassoni, founder and chief investment officer of Durand Capital Partners. I think if you folks got anything from this interview, it is discipline, developing a plan, sticking to that plan through thick and thin. Jim, thanks a lot for coming on. It's been great having you, and we'll talk again soon.
Thank you, Joel. Appreciate it.
Go Blue.